So this is our hospitality and commercial lending experts panel. Once again, our moderator, Todd Lake, is co-founder of LendingCon and managing partner of hotelloans.com. Scott Gilman is our senior development officer at Chatham Business Capital, a top SBA preferred lender. Sean Shemtov, senior area manager at SBA. And Chad Anger, founder of Hotel Loans and Brightbox Capital. Welcome, everyone. Thank you for being here.
Everybody hear me okay? I'm missing Ed Ramos. Here he comes. Ed, no doubt, handling important business in the lobby. Okay. So good morning, everyone. My name is Todd Lake, and as Angela said, I'm a partner at hotelloans.com, also a partner at Brightbox Capital. And I want to start by just thanking everyone for being here today. Really appreciate that. In particular, I want to thank our sponsors for being here today. You know, it's important that we continue to support one another and that we continue to learn from one another. And that's what LendingCon is all about. That's what this lender panel is all about. So again, thank you for being here. Now, on our panel today, we have Sean Shemtov to my right. This is Sean. Sean is the founder and CEO of CMG Capital. They're a bridge lender based in Florida, here in Florida. Sean, I've done a number of transactions with. He's very responsive. He gets difficult deals done. And so I'm really happy to have him here on the panel today. Sean has funded over $1 billion in transactions and has serviced up to $500 million of his own portfolio there at CMG Capital. So he's quite an asset to our panel today. Now, to my right is Scott Gilman. Scott has 30-plus years in commercial lending with 25 in the SBA space, specializing in both franchise and special purpose real estate. He currently heads up the SBA lending at First Chatham Bank, a commercial bank located in Savannah, Georgia. Scott and I have closed a number of transactions together. He's actually one of the most knowledgeable people I've ever talked to about SBA financing. So he is a real asset to our panel as well today. So Scott, thank you for being here. Now to my left, my far left, I have Ed Ramos. And Ed is the U.S. Small Business Administration Senior Area Manager assigned to Orlando. He oversees delivery of SBA programs and support services that help small business owners and entrepreneurs secure financing, technical assistance, business training, and federal contracts. Of course, Ed has a wealth of knowledge related to SBA lending. We're going to talk to Ed today specifically about SBA 504. We want to know the status of 504 lending today for hospitality, and also the SBA EIDL program. We're going to get an update on that. So thank you for being here, Ed. And then to my left, I have Chad Anger. Chad is my partner at hotelloans.com, which, of course, you may wonder what we do. Hotel loans. And he's also a partner at Brightbox Capital, which facilitates financing for other commercial properties like multifamily, gas station storage, and so forth. Now, of course, Chad has a wealth of commercial lending knowledge, but all different types of loan types. But we're going to lean on him today to see what's happening now with CMBS loans, the current status, especially for hospitality type properties. So Chad Anger to my left. Can we welcome the panel? Okay, we're gonna do our best to make this interesting, but we're a bunch of finance guys, and that's challenging for us. But we're gonna do our best. So we're gonna start with Sean here on the right. And so first question, Sean, what types of loans do you offer for hospitality and other types of commercial real estate? And what are the general terms of your core product?
Sure. Thank you, Todd, and thanks for having me here. And it's a pleasure to be here. And what a turnout, by the way. So CMG Capital is specifically focuses on bridge lending, and in the commercial and hospitality arena of that real estate asset class, we like to go to 60% loan to value, loan to cost. We're looking for properties in, reasonable infill areas. We're looking for, some sponsors with some experience, if not greater experience. And what? This is better. Oh, all right. Thank you. We and typically, we're lending at rates of starting around 7%. And it's a holdover in case there's a time crunch, or in case perhaps maybe the property's not stabilized yet, and then eventually the property will either be sold or refinanced with a conventional loan or an SBA loan, and then we get taken out and everyone moves on.
All right, yeah, thank you, Sean. So just make sure everyone's aware, a bridge loan, of course, is short-term financing meant to tie you over until long-term financing is put in place. Opportunities, they may present themselves in the marketplace. I talked to a couple of people today that said, hey, we're deal makers. We're looking for opportunities. And in that environment, quite often you want to move very quickly. Now, Sean, I was thinking about, while I was waiting to come up, Sean, the first deal I ever closed with Sean, or Sean did the financing for, was one of those opportunities. And so this is the fastest bridge loan that I've ever seen done. So I think I called Sean on a Thursday. He flew out on either Friday or Saturday, and then I think you closed the loan on Tuesday.
Correct.
That's fast.
Yes, and now there were a lot of third-party reports already in place.
Yep. No offense, Scott, but a little faster than an SBA loan. So good, very, very nice, Sean. So question 2, when you're looking at a transaction, of course, we know every deal is different, but what are the key things that you're looking for in order to get the transaction done?
So again, I'd say the biggest thing is skin in the game. We want to make sure that the sponsors do have real skin in the game, and they're not just over leveraging. Like I said, we like to lend up to 50, 60%, so we know we're secure by the asset. But that's really the driving factor.
And just, you mentioned that you also service the bridge loans that you fund. So the fact that you're servicing the loan, does that kind of give you an advantage over maybe other lenders?
Sure. So the fact that we service it, we don't have a board of directors. You're looking at it, and I'm able to make the decision and execute fairly quickly.
All right. So you're the guy.
I'm the guy.
Yeah. So if you like the deal, we're going to get it done.
Hold on. Let me get my briefcase.
You brought the cash? All right. Nice. Okay. Another question. What are some strategies for financing turnaround properties? I know, it's a lot of things that you've already talked about, but again, when you're trying to capitalize on an opportunity, a turnaround property, you're going to get it at a good price, you're going to increase revenue, you're going to increase the value of the property, so that is a real important acquisition for many in attendance today. So what are some strategies for being able to get financing for a turnaround property?
Sure. So that's really where, bridge lending can really be more of an asset, other than just a time crunch, or maybe the rent, the ADRs aren't there yet, and for you to get bank financing. So we'll look more at the asset and the potential down the road. Perhaps we can structure a deal where, if there is going to be some rehab work, we can also do a loan to cost of 60% or so, where let's just say you're going to buy a property for $5 million, and you want to put $1 million or $2 million into it, and maybe we could perhaps finance that as well, to give you guys extra leverage. And then once it's stabilized, and then you'll refinance and take us out with a conventional loan.
Yeah. So what's important is that that we get comfortable with the overall transaction. So many times that's not just one thing. It's a combination of things together that gets us comfortable. So we may we like the asset, we like where it's located, we like the borrowers, we like their experience, we like the upside for the property. We see that we're looking at surrounding properties, and maybe occupancy isn't where it needs to be, so we know that there's upside. We can increase the room rate, all those things together.
Absolutely.
Yeah. And another important thing is a couple of transactions that we've brought to Sean, we already had the takeout loan in place. So Sean got comfortable knowing, okay, if they can do this with this property at this point, we already have the loan in place to take my loan out, then that also helps him to get very comfortable. So anything else you'd like to add, Sean?
Yeah, just that we always strive our best, and Todd can tell you that we'll always look at all situations, and sometimes they're more challenging than others, and we try and find ways with the sponsor, with Todd, to make it work and get it accomplished. So we are creative and we are aggressive, and with good minds, good things can happen.
Yeah, nice, very nice. Thank you, Sean, for coming all the way from Miami.
Thank you for having me.
Appreciate that. Okay, so next we have Scott Gilman. Again, Scott's with First Chatham Business Capital. How am I saying it?
You said Chatham.
It's not Chatham? Chatham?
Chatham.
How am I just learning this right now? All right. First Chatham. Thank you for correcting me. Okay, so again, many years facilitating SBA loans. So our first question for Scott, of course, what type of loans do you offer for hospitality? And what are the general terms of your core product, which is SBA 7A?
Sure. Can you hear me okay? Okay. So I know later today we're actually going to have a breakout session or a session in here to talk specifics on SBA 7A financing, which I'll get into a lot of the specifics. Our group, Chatham Business Capital, we're part of First Chatham Bank. First Chatham Bank is about a $600 million community bank in Savannah, Georgia. And we have a team, a subsidiary, where we do SBA financing on a national level. We do small business lending to all facets of business. It just so happens that I do a lot of hospitality financing. I got into the hospitality space about 25 years ago, and have worked with all the major franchises through that time period. What's interesting about SBA, that especially in today's world, is it is one of the programs that both Democrats and Republicans can support, and that's unusual, because as we know, anybody that's following political events, they don't seem to agree on anything. But small business financing, SBA, has been important both to Republicans and Democrats. Why is that? Because they both realize that small businesses make up the backbone of this country. And on top of that, hospitality is like the airline industry. We're on the forefront of the economic side. We're a good indicator of what's going on a national economic level. So hospitality in the SBA space coming together makes sense, because again, if hotels are doing well, that means the economy is doing well, people are traveling, etc. So as far as SBA, our group, and I've worked with a lot of people in this room, which is great to see. The way things are nowadays, I often don't meet people until I go to events like this. It's always through the phone or through the internet or whatever, email, etc. So it's always nice to be able to see the faces. But I've been doing this for so long as far as SBA lending, because I get to work with small businesses. I get to work with hoteliers. Obviously, I've worked with a lot of hotels over the years, and oftentimes they tell me that my blood must be brown, because I'm like one of them. It's just that I've become part of the family. That's why I enjoy working with the Asian American community, especially because they're hard workers, and they work together. The family unit's really strong. I know I'm giving a really broad topic here, but I think it's important to talk about this. And from an SBA perspective, hoteliers tend to be one of the best performing assets, across the board. Why is that? Because hoteliers work hard. They pay as agreed, et cetera. So from an SBA perspective, we love hotel owners, operators, et cetera. Now, getting back to the question, because I've totally forgotten about it now.
You
What
want
was
to
the
ask the question again? Okay, yeah, so what are your core products, SBA 7A? Maybe
Yeah.
you could just, now, most people here are probably very familiar with SBA 7A, but maybe you could just give us a broad overview of the SBA 7A program.
Sure. So the SBA program, it's, you know, by definition, it's small business. So typically on the 7A program, the loan size is up to $5 million. We're usually working with that first-time buyer, maybe that second unit, sometimes a third, but then beyond that, it gets too large for us. And unfortunately, that's kind of where we are right now. You know, it's interesting when we're sitting up here on this panel, what we don't have is a bank, a true bank. I mean, I work for a bank, but we, you know, I can attest to the fact that we're not doing conventional hotel lending. We're only doing hotel lending on the 7A space. And it's just that banks right now still on the sidelines are a little leery, especially with the Delta variant. Right now, there's concerns. A lot of banks have hotels already on their balance sheet, and therefore they're not ready yet. So 7A, the SBA product, there's also a USDA product, 504 product that gives the avenues for individuals like yourself to get the money you need. So we go up to $5 million. The nice thing with the 7A program is it's aggressive long-term financing. What do I mean by that? We can go up to typically 85% LTV financing, so you're looking at 15% injection, 25-year term. Rates are really reasonable right now, primarily because prime rate is low, 3.25, and most SBA lenders are going to tie their loan to prime, and prime is really low right now, as I mentioned, 3.25. So, and then you know, we are looking to, most 7A lenders are looking to work with individuals that do have some experience in the industry. Doesn't mean ownership, but management, or having worked in the industry, and then ideally good credit. You know, most people nowadays, which I like, they know their credit score. So from my perspective, I don't run their credit, because we all know if you run credit, then it can bring down your score. I'll just ask them, how's your credit? And most, oh, my credit score is 700, 750. You know, of course, when someone has an 800, they're going to know that. Oh, I got over 800, which is really top. But typically, good credit's going to start around that 680 mark and above. When you get below 680, there's reasons for that. But not to say that people that have under a 680 credit score cannot get financing through the SBA program. It just becomes a little bit more challenging, and there's oftentimes good explanations for that. So that's what makes the 7A program nice, is you know, you can do high leverage financing long term at an attractive interest rate.
Yeah, nice. So 25-year loan, fully amortized,
Right.
based on the prime rate,
Correct.
up to 85% LTV.
Correct.
Yeah, so a very attractive loan for the purchase of a hospitality property. Our second question, thinking about our conference theme, grow your portfolio and increase profits, you know, what are some strategies our borrowers can use to acquire additional properties when they already have one or more properties, which I think everybody is interested in doing, growing their portfolio. So what are some strategies that can be used to do that?
So one of the handicaps with SBA lending, 7A specifically, not USDA, but 7A and 504 falls into this as well, is that you have a maximum exposure of $5 million loan amount. So once you get above $5 million, then you know, you cannot get additional SBA dollars. So as far as expanding, it can be a little tough, because you think about the fact that probably that may be 2 hotels at that point that's going to put you at $5 million, maybe even 1, depending on what you're purchasing, where you're buying it, et cetera. So oftentimes, you know, borrowers that have other family members that sometimes have worked with them in the past, and they may take a minority ownership in it, and those individuals become majority owners, and gives them the opportunity to own a property as well and have some support of the minority owners. Again, oftentimes it's family. especially in the Asian American community. You know, what I've found out is family doesn't mean you're related solely by blood. It could be meaning that your parents' parents grew up in a community, and your family, because y'all grew up in one area. So it seems like a lot of times in the hotel industry, a lot of those individuals work together and try to help each other out, prop each other up, provide consulting, whatever, and then it gives them the opportunity to a lot of times be able to buy more than one or two properties. It's just that one of the things SBA, and this is very important, and Ed, I know you would say this as well, control. Because SBA cares about control. They don't want an individual taking a 15% stake in a hotel, but actually controlling that hotel. Let's just say an LLC, and they're the managing member, but they're only a 15% owner. That's not going to be allowed. We, the SBA, is going to want whoever the majority owner is, or the individuals that are guaranteeing the loan, and those are individuals at 20% or greater, actually have control of the business. So they're going to have to be the managing members. They're going to have to be involved in the day-to-day operations, et cetera.
And you know, when you think about 7A financing, one thing that is really attractive about 7A is it only has a 3-year prepay.
That's correct.
So when you get a 7A loan, it's got a 3-year prepay. That's very forgiving, and you can pay a 7A loan down as much as 20% each year. Is that right? With no penalty.
Yeah, I think it's
Maybe
it may even be 25%.
20 to 25%. So, and that's every year you can pay it down. Or, of course, you know, not a lot of borrowers are going to do that. But just having a 3-year prepay, that means the 3rd year, what typically happens is you'll refinance out of your SBA, maybe with a conventional loan at a lower LTV, and then those funds are freed up again for your next hotel acquisition,
Yeah.
right?
And that's a good strategy, certainly. The prepay on the 7A, it's a 5%, 3%, 1% of the outstanding principal balance. Most hoteliers that I work with, when they purchase a hotel, they're typically looking at probably 3 to 5 year lifespan. Sometimes it's longer than that. But it's nice that after year 3, they don't have a prepay. You know, as you mentioned, you can aggressively pay down the principal balance on a yearly basis without a penalty. I typically don't recommend that, because once you put your cash into the property, yeah, you're reducing your principal balance, but if you need that cash to expand and do improvements or whatever, it's hard to get that money back. As we know, anybody in this room that's a hotelier or just a small business owner, cash is king. You need cash to grow. I mean, yeah, you can go get debt, but in today's environment, it's a little harder to get debt. So I always encourage my hoteliers, my small business owners, you know, make sure you have a strong current assets, so your liquidities, and look at building your retained earnings. But yeah, it's a very attractive prepay, the 7A is. 504, it's a little different. Ed may talk a little bit about that.
Very good. Yeah, thank you, Scott. And for any hoteliers we have that currently own a property that are thinking about selling in the future, or you know, a lot of individuals here are always looking for a deal. So they'll buy a property, renovate it, increase the value, the revenue, and then they'll want to sell it after a few years. So what are some important things to keep in mind so that in the future, when you sell your property, you command the highest price possible at sales? So what are some things that we need to be doing today to ensure that?
I mean, that's a great question. You know, one of the things that you need to be very, hotel owners, and really any small business owner, is how relevant social media is, online reviews, TripAdvisor, for example. You know, unfortunately, I know this because I work with hoteliers that tell me this. Unfortunately, you can get bad TripAdvisor reviews, and it's not even something you've done. It's just that individuals come in, they're looking for a discounted room or whatever. They want to, they work it. They work the system, and that's unfortunate. I think in those situations, if you're an owner of a hotel, you want to respond to it and just say, hey, I appreciate your feedback. We're always working every day to make our property better, et cetera, et cetera. But online reviews are important. The second item that you should be looking at is reinvesting in your property, continuing to try to enhance it. Being a hotelier, the key is to find that sweet spot. High occupancy, high ADR, but too high of an occupancy is going to create a lot of stress on your property, correct? And there are some strategies. Some hoteliers will try to drive occupancy up and keep the room rate depressed, but you really want to try to find that sweet spot that or have good occupancy. Look at your star reports as far as what is your competitive set showing as room rate. And then obviously that's going to drive your RevPAR up. But from a hotel perspective, how do you get the most money? Obviously, you've got to drive top line revenue, reduce expenses, right? Because your NOI is going to, that's what the cap rate is going to be driven off of, and that's going to be your valuation. But in today's economy, that's where it's getting tough. As we saw by the slides, the room rates are starting to increase, which is great, but the problem is your expenses are increasing. Labor is going up, food costs are going up, and there's some strategies right now that hoteliers are doing, maybe not even intentionally, but because of COVID, they're not having the rooms being changed over on a daily basis. That's what's happening. At one time, breakfast wasn't occurring. Now that's coming back. But it's going to be tough because we are in an economy where, people are traveling. People still want deals. But room rates, it's kind of good to see those rates that go up. I mean, in some ways that's good. Some ways it's bad because I'm a consumer. I don't want to see that. But also, to be a successful small business owner, you've got to do that because everyone knows expenses are going up as well. So the key is to try to drive revenue, reduce expenses, and get your NOI up. Sounds easy, but it's not. I know.
Yeah, of course, that's running a hotel.
Yeah.
But now reviews are important. I've got some really nice transactions that the reviews were really bad and it made it difficult to get done. So we got to watch the reviews, of course, revenue, and invest in the property. So very good feedback. Thanks, Scott. And then final question, just briefly because we need to go to our other panelists. But financing turnaround properties, that's an important theme for us today. What are some strategies for the SBA to help us do that? Now, one thing that's great about the SBA is because since the federal government is guaranteeing a percentage of the loan, then because it's SBA financing, some transactions that maybe a conventional lender wouldn't look at, we can get done with SBA. Maybe cash flow is not what we want it to be, but we see upside. So just some strategies for financing turnaround properties briefly.
Yeah, sure. So turnaround properties are tough because, in some respects, a startup's easier than a turnaround. Because a turnaround, that's what you've got. You've got basically a startup because you're saying, don't look at the historical numbers, look at the projections. But it's hard from a lending viewpoint not to see the historical numbers. So strategies there are, oftentimes it's mismanagement. You don't have a hands-on owner-operator, and you can see that maybe in the reviews. You can see that in the labor expenses. Instead of labor running 20-25% of sales out, historically it's been at 35%, which is really high for a limited service property. So you got to make the case. Maybe it's a flag change. Maybe it's an independent property that you're going to convert over to a franchise, or maybe it's a limited service property that you're going to convert over to an extended stay. You got to make the case why you feel as though you're a better operator than the previous individual. That's the ideal, but having a turnaround. Now, what we'll do, and a lot of lenders will do, is we'll work with you in regards to that, but then we may want to get an appraisal done on the front end to confirm that it truly is still a viable property, because unfortunately there's properties that it isn't mismanagement. It could have been because the hotel was built at one exit and all the businesses moved into the next exit because that's where the new development is. And then you're in a more difficult situation because that's just your market's moved away from you. So
right. So just like with working with Sean, we want to make the case. And quite often we're able to do that. What happens with any loan, an SBA loan included, is that you're going to take that to a loan committee and they just want to be comfortable. So quite often it's the partners who are coming in on the transaction. Maybe they've turned that type of property around before and they have significant experience with turnaround properties. That's a big help to get them comfortable. Again, how is that market performing? And if this is performing under market, that's going to really help get it done. Experience is a big factor. So all those things together, I've been surprised. Well, first of all, as Chelsea mentioned, the hospitality industry has just come roaring back. So we're seeing, high occupancy rates, good revenue, and some really good cases for SBA financing. So if we're looking at a property and we feel like, well, actually, typically when somebody comes to us wanting to buy a property, they've already done their due diligence. It's rare that someone with significant hotel experience is going to bring us something and us say, why are you looking at that? You shouldn't do that. Quite often they have experience and they already know that they can get it done. So we've had great success with 7A for turnaround properties. I also wanted to mention that the SBA 7A does only go up to $5 million, but we do have SBA lenders that will offer a para pursue in addition to the $5 million loan. So we can get up to maybe 6.5, or maybe even do a $2 million para pursue, which is a second loan on top of the 7A to get up to maybe a $7 million loan amount, which is very beneficial working with an SBA preferred lender.
Let me
So it's
add real
attractive.
quick, 'cause that's a good point. Para pursue, but
Then we got to move on, Scott.
yeah, we're going to move on.
After this.
Okay, so on the para pursue though, the problem with that is the conventional. You still have a conventional note there with the 7A. So the para pursue is a shared first position. You have a 7A loan, maybe $5 million, and a $2 million conventional loan that they share a first position. That's a para pursue. The problem is you got to find we used to do some para pursues. We're not doing them right now because it's all about exposure right now, and that conventional loan is conventional dollars. Just like to a bank, that money is important. We can lend more under the 7A program than we do under the conventional program. And then real quick, I just want to mention on the SBA 7A program or any SBA program, make sure you're working with lenders that know what they're doing, they know the program. That's where the problems are that, hey, I don't want to do 7A because it takes forever. Quite frankly, if you're working with a lender like us that have experts and have been doing it a long time, we can approve and close a loan is just as quick as a conventional lender. We're a preferred lender, which means we have the ability to directly underwrite and close. The SBA approval is automatic, and then there's only a few preferred lenders that exist.
I'm glad you mentioned that. HotelLoans.com only works with SBA preferred lenders, which basically means they can make the lending decision, not have to submit to the SBA, wait for the approval to come back. So that can make it pretty quick. In fact, the fastest SBA 7A we've ever closed was about 3.5 weeks, which was very fast. So some of these lenders can move very quickly. Okay, let's move on. Thank you, Scott, so much. Fantastic feedback. We appreciate that. All right, so now we're going to move down to Ed Ramos. Not Ramos, Ramos.
Hey,
I got it.
I don't mind.
All right, and so Ed, question one, what types of loans do you offer? Now, we're going to talk about 504 today, and then what are the general terms, I guess, of the 504 program? Just kind of high level.
Sure. So the SBA has multiple products, but the 504 is basically a program that was created in the 90s for job creation. Usually we call it the 50-40-10 because the program is structured in a way that 50% of the loan is guaranteed by a bank. 40% of the other guarantee is offered up by a certified development company that represents SBA, and the other 10% is the cash injection from the borrower that is interested in buying the property. This 504 program can be used, has been used, and will continue to be used by hotel acquisitions, renovations. As long as there's a property capital asset involved, is very useful for individuals in this industry.
Yeah, thank you. And the max loan amount for 504?
Okay, so the maximum loan amount on the 40% part is $5 million. So when you do the total value of the loan, you're actually looking at a total loan amount of around $12 million, maybe higher. If the loan involves manufacturing, we can go up to $5.5 million.
Okay. And, just like other forms of financing through COVID, it's become more challenging, right? So the SBA 504 in particular has been a bit more challenging in the last year and a half. Why would you say that is the case?
Well, the fact is that we had products that were created to meet the pandemic demand, and they created a competition with the 504 and the regular lending that we have within the SBA. So a lot of the users that are here today, I spoke to them, and they pursued the PPP route. So they were able to acquire some money to keep employees on the payroll, and many of them have economic injury disaster loan, the EIDLs. So, I'm the Central Florida sort of like relationship manager, and talking to many institutions, I found that they didn't have appetite for regular SBA lending, although at the national level we had a record year. We broke the record this year. So it's hard to comprehend from my little mind, but I'm glad that we did raise the bar.
Yeah, thank you for that, Ed. And then, of course, like you mentioned with the 504, there's the bank component. And since conventional lenders, regular banks have become more conservative, that's made it much more difficult to get 504 done in this environment. But again, as we mentioned earlier, as Chelsea alluded to, the industry is really coming back, occupancy rates, revenue. So we expect 504 to really come back and be a great lending source for the hospitality industry. Now, you were going to mention the EIDL loan as well. What is the current status of that loan, how it relates to specifically hospitality?
Okay, so the EIDL program was enhanced recently within the last couple weeks. Now, we started with a $150,000 amount, and we slowly moved into the $500,000, and now we're up to the $2 million amount. We offer a 24-month deferment on payment, and we had a special, priority period for EIDL request under $500,000, which expired on this past weekend, and now we're doing the up to $2 million program. I've seen quite a few of them getting approved.
And Ed, the basic qualifications. Turn my mic off. Can you hear me? Okay. User error. So Ed, the EIDL program, could you just give us a basic overview of that program?
Sure, that's a common program that exists within the Office of Disaster Assistance, which is another office within the SBA. The Disaster Assistance Office is the only one that can do direct lending, where in the regular SBA office we do guarantee lending. So the law that governs that section of the SBA allows them to do up to $2 million. For-profit or non-profit, because we changed the rules, and it depends on the disaster declaration. So depending on the area, for COVID, this is a nationwide disaster, so it's open to anyone. It's open, the funding is available until the end of this year, 12/31. So we're asking people to, if they haven't done it, to submit their paperwork as soon as possible.
Yep, and it's a 30-year loan.
30-year,
3.75% rate.
3.75 for profit entities.
All right. Yep. Thank you very much. Thanks, Ed. Thanks for that information.
Thank
you. Okay, let's move along to the last member of our panel, Chad. Again, partner at hotelloans.com and Brightbox Capital. Ed, can you have your mic?
Yes, sir.
Okay. So Chad, of course, has extensive experience financing multiple types of commercial properties, using different types of loans. But as we mentioned, we're going to focus on CMBS today. So question one, what is a just overview, what is a CMBS loan, and what are the basic terms?
Sure. Thanks, Todd. Well, that was, sorry, guys. Figure out where to hold this. So I guess since I'm talking about CMBS, they didn't want to give me a mic today. I know that, unfortunately, a few of you, I'm sure, had some poor experiences with the servicing side of CMBS, and that is unfortunate, and we certainly understand that. But to get to your question, CMBS really is a fixed income security product, right? So it's a product that's pooled a number of loans together and then sold on the open market. And so really what we're seeing is the market dictating what they want, what kind of hotels, if it's hotel specific. Last year we really didn't see any CMBS loans getting done because the market was just unsure of hospitality and how it would turn around. Now we're starting to see it turn around, and so the market is starting to take and originate some of these CMBS loans, and they are being sold on the open market, but it's for what price? And so a lot of CMBS lenders today are still really pushing back on leverage specific to hospitality. So where we're seeing maybe max LTVs at 60, 65%, right? They want they want hotels in very good locations where they can ensure that they're going to get revenue and they can pay the mortgage. They want high-end flags. They want lots of experience. Loan amounts $5 million plus. So there's a lot of nuances to that product.
Yep. And CMBS, what are some attractive features of the CMBS? So there's some negatives, but there are some attractive features. What are those?
Sure. Look, it is a great product. I think, so if we look at specifically the attractive features, right, it does have low rates comparatively to a conventional loan. It has a low rate. Now, a conventional loan, it's really the bank lending its own money, so CMBS is money that's pooled. And so if you think about that, the other attractive thing is they allow things like cash out refinances. So if the market says they'll buy that loan, they'll allow that company or that hotelier to take cash out. That's a very positive thing. So you can use that money, put it to work, whether for renovations or to buy another property. Another huge benefit is it's non-recourse. So for people that own several hotels, a lot of times they don't want to fully guarantee a loan. Typically where a conventional, another similar rate product would want that, CMBS is non-recourse. It's just based on that property.
Right, and a 30-year?
Amortization is typically, 25 to 30 years, yeah.
Okay, and those are some positives, but downsides of CMBS lending or a CMBS loan?
So I would say...
The prepay, brutal.
The servicing and the prepay, are the elephant in the room, right? So servicing typically is done by a third-party servicer. It's rare that you find a CMBS lender who's you're working with on the front end of the sale of that loan, and then they likely will have a sub-servicer. And they've been known to be difficult to work with and, require lock boxes and other bad things, and not work with you as much as we would like. So that is certainly an issue. I think it's also important to note the term. So we talked about the amortization, where typically it's 25 to 30 years. The term is somewhere between 5, 7, or 10, right, depending on what you're looking for. So it's really important to understand your goals going into that loan. You don't want to get caught in a situation where your goal is to keep the hotel long-term, keep it in the family, and you find yourself in a 5-year term loan with a 30-year AM. Well, that means that you're going to have a balloon payment at the end of that 5 years, and you're going to have to find another loan for it. So you just want to think through all that up front.
Yeah, of course. So any type of financing for any type of commercial property, it's important to firmly have in mind what your goals are. So CMBS has its place. So large loan amounts, practically no cap, low rate. The loan is assumable. So those are very positive things for CMBS. And so CMBS, again, being very conservative, maybe at 50% LTV right now. Major markets, it has to be a really clean deal. But we do expect CMBS, as the market continues to recover, to be a really good resource for hospitality lending. Finally, let's see, what is the last question? Okay, Chad, besides CMBS loans, SBA lending, bridge financing, and other types, what other types of loans are available to hoteliers in today's marketplace?
So today's marketplace is the key there, right? Because historically, we've had lots of great options. We've talked about conventional loans in the banks being a little more conservative, though we do have some of the larger banks that are starting to enter that market and look at certain hotels as their willingness to lend on it. There, it's about the relationship. It's also about the type of hotel, the location. It's got to really check all the boxes because the bank's money is at risk. We're also seeing some CMBS alternative lenders come into the market, things where they're addressing both the prepay, where they're having, structuring prepays differently, and they are servicing their own loans. So you have that direct relationship, and it helps in times of trouble. We're seeing other family office money starting to get interested in hospitality. We're seeing mortgage REITs come into play, where they're looking at hospitality as a good option here in the near future as things turn around. So I think we're going to start to see that open up quite a bit soon.
Okay, very nice. Yeah, thank you, Chad. All right, so we do actually have a few minutes. If there's a question from the audience for a member of the panel, we're happy to take a few questions. Angela?
Hello, thank you, panel members. Do we have any questions at all? We do have a few minutes.
We should probably mention, too, the afternoon session. We are going to do more of Q&A.
Yeah, I thought we might have room, time for one or two now. And then, yeah, I did want to mention, we do, in the afternoon session, have a question and answer panel. And in order to submit, if you want to submit your question in advance, what you can do is we have a kiosks in the lobby. All you have to do is scan the QR code, and then a form will come up. You can put in your question. I'll get that directly, and then we can include that in the afternoon panel question and answer session. Or if you don't want to do it that way, you could write down your question, hand it to me with a $100 bill.
I love it.
Yeah, and we'll get it on the panel. But I thought maybe if anybody had a question now, I'd be happy to take it. If not, then this concludes our lender panel for the morning. Can we have a round of applause for our lenders?
So no questions? Are we good?
Okay, thank
All
everyone
right,
so
thank
much,
you
and
all.
thank you for coming.
Thank you, panel members. Thank you so much for all the info. All right, we are